In the past, historically, that's taken 120 days to turn a prospect on average into an actual customer. If I can reduce that down to even 90 days, what does that mean for you? It means you've just saved 30 days of sales capacity. The faster you get paid is not just good from a cash flow perspective, but the faster you get paid does two other things for you. You will collect more of what's owed. It's a big deal. The principle is velocity matters. Faster cycles makes your business more successful and more profitable.
Maui Mastermind presents the Business Coach Podcast, answering your questions and providing real actionable insights for building a better, stronger, more profitable business without sacrificing your time, life, or freedom anymore.
Hi, and welcome to The Business Coach. I'm your host, David Finkel. In this episode, we're going to talk about your cycles and how to make them faster and accelerate them so that we can increase your company's profitability. So we're going to start off with this idea of what is a cycle, and I'll give an example. For example, your sales cycle. Your sales cycle starts the moment you find a lead, and you turn that lead into someone who actually has signed and has become a customer of yours, a client of yours. That's your sales cycle. And in every business, there's a certain length of time that it takes. If in the past, historically, that's taken 120 days to turn a prospect on average into an actual customer. If I can reduce that down to even 90 days, what does that mean for you? It means you've just saved 30 days of sales capacity, and that 30 days of sales capacity can now be invested in the next sale, which is going to ultimately make you a lot more money with the same sales capacity for the same sales overhead. That's an example of speeding up your cycles. Now, it doesn't have to be with your sales team. It could be with your production team. So let's look at our production cycle. So for example, let's imagine you were a CPA firm and it currently took you 90 days on average to do a tax return, on average. Some are faster, some are slower, but on average 90 days, which on the surface of it, for those of us that don't run CPA firms, we'd say, well, that's way too slow. But if you were a CPA firm in the middle of tax season and you never really looked at your cycle, you would probably see that that is not unreasonable for a slow CPA firm. But if we could take that down and go from 90 days and turn that into 30 days, think about that. 30 days means that we've freed up effectively 60 days worth of capacity. And more than that, all this overhead, it took before 90 days of overhead, of fixed overhead, where now we're only going to need to have 30 days of fixed overhead for the same amount of revenue. That's a big deal. It makes your company more profitable. So these are some examples of cycles. I'm going to go into depth on what I think is probably one of the least understood cycles, which is your onboarding cycle. And we'll come back to that in a moment. We'll just talk about these two first of all. So with our sales to lead part, we can ask the question, where are leads getting stalled? What's the current process? For example, you might have a lead comes in and that lead has a certain set of emails that get sent to that lead. A phone call is made to that person. We're trying to make the first phone conversation this way, and then we set up an appointment, and then there's a follow-on appointment, and then the decision gets made. I mean, that sales cycle is extended. And I'll give an example. We have a client that works in the home improvement space. It used to be that a lead would come in and they would talk to that lead, call them back or get them on the phone. And the first place that they sped up the sales cycle was to make sure that they were answering the phone, right? You think about it. A phone call comes in. I can answer it right now, or I can spend an average of 1 to 3 weeks trying to call that person back and get them on the phone. Not only do I lose and have attrition of leads that drip out the bottom if I don't answer the phone, but if I answer it now, I might save 1 to 3 weeks on my sales cycle just from answering the phone. It's a big deal. It's a big deal. Now later on, the same sales force they would go do a visit, and then they would do a measuring of the house and for what they were going to make for them, produce for the home improvement. They would come back and price it out in the office, get supplier quotes, etc. And about a week or two later, they'd go back in for a second appointment with them. And that second appointment, they would hopefully close the business and they'd answer questions and have some follow-up, etc. But what if they condensed that, not just these 2 appointments? What if they turned these 2 appointments into 1 appointment, which is what they did. They went to a 1-call, 1-visit close. To do that meant they had to have a way to be able to estimate jobs fast and accurately so that they didn't price themselves too low on a job and lose margin or lose money on the job. And they got very good at how to do that. Started off with a really good spreadsheet, turned into a pricing tool that was more app-based on an iPad, and it worked really well. And they still do that to this day. So how can we shorten sales cycle? In terms of production cycle, let's talk about that one here, right? That production cycle for that fictitious CPA firm, you think about how many steps in a production cycle there are. Like, I'll use the CPA example, right? To do this, they're going to need to ask for the client to send them certain information. Hey, Silvio, you want us to do the tax returns for your companies? This is request number 1 for you to send us the following QuickBooks and or accounting information we need from you. Well, hello to the podcast audience. I don't know if you've yet had the chance to get into the Business Growth Toolkit, but my staff and I have spent a year and a half putting together a collection of the 6 most powerful business growth tools that you can use to help scale your company, to make it more profitable, improve your margins, and to make the business more owner independent. The toolkit's available to you for free. It's our gift to you for being part of the extended Maui community. You can see it in the show notes for a link to get your toolkit access right now, or simply go to MauiMastermind.com. That's MauiMastermind.com. Click on the resources button and you'll have access within a few seconds there of these particular tools. I wish you every success in scaling your company and truly building a business, not just owning a job. Oh, we still haven't gotten that. 2 weeks later, hey, Silvio, you want us to do your tax return? We need to get that information. Finally, 30 days later, they get the information. They start on the tax return. Here we go. They get busy. They come in. They go out of that. And somewhere around about the halfway point, they've done a lot of the tax return, but they had a question that they sent over to Silvio, and they haven't had an answer back yet. And now another 30 days goes by, and finally Silvio gives them an answer. They're busy now working on other stuff, and eventually they come in here and do the final work and deliver it to Silvio, but it took them 90 days for that full cycle to go through. What they need to do is just simply step back and ask, if we were to scrap our old process and redesign it from scratch, what would we do? Maybe you would have access to the person's QuickBook online as a CPA firm immediately. Maybe you would have some admin liaisons who are responsible for working with the client to get information and coordinate those activities, so your CPAs spent their time actually doing the tax work in the software versus doing a lot of the collection and the interaction with the client in terms of emails back and forth to pass messages or pull back information, etc. You can shrink that time, and what that does is it takes your overhead and shrinks that overhead to a smaller space, plus it helps your cash flow. Because you started spending money on doing the tax returns, but in most cases, a CPA firm doesn't actually bill for the work until it's been delivered to the client. So on this old way, where it took them 90 days to do the tax return, then another 30 to 40 days to collect on the tax return work that they did, they might be 4 months of out money where they've been paying CPAs and enrolled agents and administrative people before they get the money back. That's horrible. And you'd say, well, shouldn't a CPA firm know better? Well, yes, but many don't. I know we've had enough CPA firms as clients, and we've got them to do things like charge a deposit up front, shrink the cycle to 30 days, bill immediately and collect immediately from that point in time. There's lots of things that you can do on that. The cycle that I think is probably most important is the one I want to talk about. Actually, let's do 2 that I want to talk about. Let's do collection cycle. I think that's an important one. And let's come back in and talk about your onboard cycle. So let's do collections first. I'm going to use that one here. So a collection cycle works like this. So the collection cycle, if we were to kind of map it out, starts with money being owed. So this is the starting point of money being owed. And usually what happens is money's owed today, but I don't invoice for 30 days. So 30 days later, I send out the actual first notice of the invoice. Quite commonly, that first notice gets some small percentage of your customers to pay, but the majority of them don't pay. So time goes by and you send a second invoice. It's not uncommon when I first start coaching a client to find that they're waiting another 30 days, and the next time that they do and run all their invoices, they send a second notice. And then again, at the day 90, 30 days later, they send the third notice, which sometimes they'll mark as the final notice, and they'll say that if we don't get paid, this is going to go to collections. Now, at that point, they're now extended it out. When we look at this more rationally, we say, hang on a second here. We're only invoicing once per month. Why don't we invoice or look at what invoices need to be run on a weekly basis? So worst comes worst, this person might have gone 1 week later and we're sending out their invoice. Why don't we make sure that if we're not getting paid within, say, 10 days of here, we're going to go ahead and 10 days later, we're going to send out another second invoice, but we're also going to make a phone call. Hey, Paul, I know you're the accounts payable person for Acme. We're so thrilled to have you as a customer. You know what? We just sent you a second invoice. The first one was sent 10 days ago. It was invoice labeled 221, and we've just sent you a second notice of that same invoice. Did you get that? Can you just quickly take a look to confirm that you received the invoice? You did get it. Wonderful. Did you want to take care of payment over the phone? Okay, you're going to write a check. Not a problem. When were you going to send that payment out so I can put it here in the notes? Were you going to send that out today or this week? Oh, you're going to send it out this week. Wonderful. I tell you what, I will personally circle back with you if we don't receive that check. If we don't get that, let's see, today is Thursday. If I don't receive that by, say, next week on Thursday, I will give you a call on Friday morning letting you know that, hey, something went wrong with that. Is this the best number for me to call you at? Right? You see what you're doing? You're just raising the bar. And when you do simple things like that, you're going to get paid your money twice as fast, 3 times as fast. And here's what you've learned over time, or we've learned over time. The faster you get paid is not just good from a cash flow perspective, but the faster you get paid does 2 other things for you. You will collect more of what's owed. It's a big deal. The average business, and we first start working with them, we'll see that the receivables are anywhere from 5 to 15% or more uncollected receivables in a typical year. Just even think about that 5% level. If you have a business that has 5% of their receivables are not collected, of uncollected receivables, we'd say that this is a business doing $10 million a year. That 5% level represents $500,000. That's pure profit that would drop to your bottom line if you only collected it. If you collect it faster at this part of the frame versus waiting for 90 or 120 days or later, you will collect proportionately a lot more of it, because the longer it extends, just the way it works out in the real world, the less or fewer people you'll actually get paid from. It's a big deal. Plus, the second reason it makes you more money, if you collect the money within 30 days, you don't have to keep following up, keep following up, keep following up. So you don't have all the overhead of these other days of collections, wherein if you collect it in the first 10 days, the first 30 days, the first 40 days, versus the first 90 days, you saved anywhere from 1 to 2 months or more of collection overhead. That's a big deal. And the biggest reason is it really, really helps your cash flow, especially if you're a rapidly growing company. That funding of that growth is really painful at times. And if you're fast, if your collection cycle is fast, if it's 15 days, 30 days versus 60, 90 or longer, your average collection days, it means you need less capital for funding the growth because you're collecting your money faster. And on that same note, the very best collection cycles are actually negative, wherein you collect your money in advance of doing the work of paying cost of goods sold out. And so, for example, maybe you start doing things like collecting larger deposits up front, or maybe get paid in full up front. Or if you do an ongoing service, maybe you're getting paid in advance of the month for which you're producing the service. These are examples of how to not just shorten the collection cycle, but in some cases, to make the collection cycle go negative, which means you collect your money before you pay out any of your costs to produce that product or service, which is a wonderful thing. I know it sounds weird. David, do I want a negative collection cycle? Sounds like a disease. No, it's a beautiful thing. A negative collection cycle means you're getting paid in advance of having to pay any kind of costs out. going to talk about one more cycle. And this is one I got into a really heated conversation with a coaching client on about 6 months ago. And so in this particular case, we're going to talk about this as your on-board, your hiring and onboard cycle. So I'm going to change some of the details here about this client. So we're going to call this client Harold. So Harold owned a successful business, and in his business, there was a specific role. We're going to call this role the technical role. And he had 15 people playing that role currently, and over time he was going to need 20 of them. And over time, if he kept growing, he would need 30 of them. And that number he was going to need was going to keep increasing and increasing and increasing. Now, when we were talking about this, it used to take him approximately 1 year to find, recruit, and hire, and onboard and train up to a certain level of knowledge this technical person to do their role. 1 year. So if he has growth, can you see that another way to think about this, if it takes me a full year, if I know that I'm going to need 50% more people, I'm going to have to start a year in advance to start paying the cost of those people before they become fully productive and producing for the company. Right? That's really expensive. It's almost like if you think about your hires as inventory, I need to have, the longer it takes me to reliably find, onboard, and train these people so they're producing in the job, the more inventory I need to have of these people to cover my growth. So if I can take that 1 year and reduce that down, like we helped him to do, to 12 weeks, what that meant was, he could do this where he needed, 1/4 the amount of inventory of these people in advance to the growth that he had. It was huge for him from a cash flow and from a profitability standpoint. You say, well, David, how did he make it effectively 4 times faster to find, hire, and onboard and train these people? Well, the first thing he said was, why was it taking us so long to find these people, and why was it taking it so long to train these people? So first of all, to find these people, he started creating a bench. He created a waiting list for the company such that he had relationships with dozens of people who would want to work for him at some later point that he kept in contact with. They were all working for other places, and it could be the case that when he was ready, somebody didn't want to leave where they were at. But it's better to have 14 or 16 people who want the role, that chances are 1 or 2 of those people are ready to come off the bench than to go from scratch if this is hard. That's the first thing he did. The second thing he did is he simplified his product line. So one of the reasons why it took so long to train this technical person is he had over 1,000 different products when we were talking, 1,000 of them. When we asked him to do the analysis, what he discovered was that there were about 25 to 50 of these products that were responsible for 80 to 85% of his actual revenue. And so by doing the initial training on these 25 to 50 products for this technical person, he was able to shorten by months the time it took for him to train somebody new to be productive for the business. And then over time, he could fill in the other knowledge that they were lacking over time in an organized way, in a drip, drip, drip way. So by doing that, he was able to find people now in a 12-week period and make them productive, which means he didn't have to hire nearly as many people. He didn't have to hire them nearly as early in covering the overhead until they were productive. And he made them productive in the business so much faster by using a bench of protected candidates that he kept in contact with. Every 2 or 3 months, he would just reach out with a text, a phone call, an email, just to touch base. You might even just send a note, a handwritten card. Hey, I hope you're doing well. I was thinking about you. Just that part to keep the relationship there. And by simplifying in a strategically intelligent way from 1,000 products, training them on all of them without taking into account the order in which you did that, starting with the 25 to 50 that were representing 80 to 85% of his business, lo and behold, it works so much better. So coming back to this for you, how can you simplify your cycles? How can you speed them up? The first thing I'm going to suggest that you do now as your coach is I'm going to ask you to look at which cycle currently most holds you back. Is it, if cash flow is a big issue, let's look at your collection cycle. And if it's not that, let's look at your production cycle. If cash flow is a challenge, collections is usually the first place I'm looking at to speed that cycle up. The second place I look at is my production cycle. How can I make that more efficient? If it's not those two, then it might be one of the other cycles. But those two probably account for 80 to 90% of the issues. If cash flow isn't the biggest challenge, it's actual revenue in terms of scaling larger, then for you, it's probably how do we speed up our sales cycle or our marketing cycle, right? That's probably the big one for you. If for you, capacity is your persistent challenge, then speeding up our production cycle and our hiring and onboarding cycle, those two probably have the most importance to you. So those are some examples of how you can look at speeding up cycles. And in your business, when you start looking for them, you have cycles all over the place. You have your repurchase cycle. How fast can you get your customers to buy again from you? You've got your referral cycle. How fast can you get clients to refer more clients? How fast can you get those new clients to refer more clients? How fast can you get these old clients to refer a second and a third wave of clients to you, right? And then there's another cycle that we'll call your cash flow cycle, which we've talked about. So the principle is velocity matters. Faster cycles makes your business more successful and more profitable. So here's what I'm going to ask. Pick one thing from today's podcast, one thing that you can take and put into practice in your business. One thing, maybe it's to speed up your training cycle, to go from 30 days to 10 days, to go from 1 year down to 12 weeks. I was talking about this with a medical client recently. They train nurse practitioners that come into their practice, and they have a year-long training program. Well, he just discovered that one of his competitors does that same training program in 8 months. Wait a second. They can have more people through, and they're doing it 4 months faster. That really got his juices flowing. He said, well, I don't know if we can take our 12 months down to 8, but I bet we can take our 12 months down to 10 and do it that way. Right? Maybe for you it was the production cycle. How can we speed this up? Maybe for you it was the sales cycle or the collection cycle. We'll pick one of those and then make one action step that you're going to take to speed up that cycle. What's the one step you could take in the next 30 to 60 days to speed up that cycle? Right? Small little improvements to your business, if they're strategically chosen, compound for you and for the business's success. This improvement might make you 4% better. Then this next improvement might make you 3.5% better. This next one might be a whopping 7% better. But if I do that each and every quarter in the business over the course of 3 years, 5 years, 7 years or more, your business is going to double, quadruple, 5x, 10x. And this is what we see with the coaching clients we work with. It's small, important improvements that aggregate and compound over time. Thank you for spending the time with me here in this week's episode of The Business Coach. I wish you every success as you work to accelerate your cycles in your company.